In today's video, traders, we're going to be talking about the stochastic indicator and how you can trade it like a pro, how and exactly what the stochastic indicator is and how it functions. We're going to talk all about this tool as well as some different ways that you can actually apply it into your own trading. So let's go ahead and jump into it. What exactly is the stochastic indicator? Well, the stochastic indicator is essentially a tool that measures the momentum of a price direction in the market. So as prices are moving one way or the other, the stochastic indicator is going to be looking to try and measure the momentum at which the market is traveling, right? So as things are, you can kind of visualize it if we grab our pen here. A market is either moving up or it's moving down. And if it's moving up, then the stochastic is going to try and measure how strong a market is moving. So if a market is in an uptrend, right? If price is moving higher, the stochastic indicator is likely going to tell us that momentum is strong to the upside overall. And then what we can also use the stochastic indicator to look for is the potential shift in momentum. So as a market starts to quiet down or slow down, sometimes the stochastic can help us identify points at which the momentum of the market or the price is shifting. It's essentially an oscillator that can be used to spot shifts in momentum or strength in a particular market. So let's take a look. What next is we've got the measurements. Now this is going to be important for any sort of oscillator or indicator, is we want to know how the tool is actually going to be working. And what we have here is that you can see here is the stochastic over here. We'll put S for stochastic. You can see here the indicator is on the bottom of this chart that I've got pulled up. And you can see the stochastic has a range from 0 to 100. So 0 is going to be down here at the bottom of the screen, and 100 is going to be right here at the top where this line is right there. You can kind of see it's cut off from the screen. I apologize for that, but you guys get the point. The 100 is the top of the range and the 0 is the bottom of the range that the oscillator is going to trade or travel back and forth between. So the idea here is that 80 and above is considered an overbought market. So what you can see is that here is the 80 mark, this little mark right here. The purple zone is in between. So we have the 80 and here's your 20 right here at the bottom. Okay. So when price is traveling in between this area, then we are neither overbought or oversold. In fact, in those situations, we are just kind of traveling normally. But when price enters into these regions here, this is where things get interesting. So this region at the top and this region at the bottom between the 20 and the 0 mark, right? These are going to be our interesting levels of either overbought or oversold. So remember, we said that 80 and above is considered overbought. So we'll put OB for overbought. And down here we have oversold is the idea down here. And so the idea here is when the stochastic prints underneath the 20 period, the market is considered oversold. So that's great, but now let's understand a little bit more about what's going on here. So again, we mentioned that the stochastic is meant to measure momentum in the market. You can see we have the price up here and the stochastic underneath. So what we can kind of see here is that as markets are moving one way or the other, the stochastic below is trying to print momentum. So you can see as price started to rise here on this chart, you can see so did the stochastic. We printed that we had kind of a rise in momentum to the upside. However, what you can see is that once price started to reach this overbought zone that we mentioned, right? We'll clean this up a little bit. Once we started to reach this overbought zone here, take a look at what happened with price. We were stretched a bit. You can see I've got this red arrow pointing that we started to print overbought, and sure enough, the market rolled over. And then you can see when price came down to this point, we have an example of a oversold point. You can see it lines up very nicely and price rallied from there. We had again another overbought point right here. Price fell from there. So you can see the stochastic indicator by itself is pretty interesting. It measures potential areas on the chart where price may be overstretched one way or the other. Now, it's not a perfect indicator. Of course, there never really is a perfect system or indicator. But the idea here is that it's essentially going to be tracking the momentum of this market. But we have another question that a lot of people will start to ask, which is what are the two lines? Why is there two lines rather than just one line? So what we have here is that the percentage K is the fast stochastic line, which is going to be this blue line, right? So the percentage K, and then we also have the orange line. We'll point it right here. This is going to be the percentage D. Okay, and the percentage D is essentially just a slowed down version of the percentage K stochastic line. So this is just kind of a little bit lagging on purpose, right? So what this allows us to do is you can see there are points on this chart where we start to see the crossover of these two lines. And the crossover of these two lines, as you can see here and you can see here, is sometimes considered a signal to potentially get long or short. So if the blue line crosses underneath the orange, the idea here is that we have a sell opportunity in favor of a shifting momentum. Remember, we mentioned that the stochastic can be used to identify points where momentum may be shifting. It's not a guarantee, of course, but it's an idea where we may see the shift in momentum. So here we have examples both on the long and short side. So that's just one of the few ways that we can take a look at the stochastic indicator. We can look at it from the sense of, okay, it's stretching overbought or oversold. And we also have the idea of using the percentage K and the percentage D line to identify crossovers or shifts in momentum there. So now let's talk about a reversal example. So there's a couple different ways that we can talk about using the stochastic here. We could talk about potential reversals, and we'll have some other ways that we can get into in a second. But for starters, let's talk about the reversal. The reversal of using the stochastic is kind of what we were already talking about, right? We had the idea that when price comes up to a stretched point like this one, you can see sometimes that can identify a reversal in the market. You have points like this and this where you can see we did have minor, jump ups, right? Oversold levels turned into buying zones, right? And then you have ideas here where price is looking stretched to the upside as we are printing that on the stochastic. So for reversals, that's going to be one of the two ways. We also mentioned that we can look for crossovers on the percentage K and percentage D lines, like this one, which gave us a beautiful sell signal, right around this area up here. Right, showing the momentum was starting to shift to the downside prior to when price actually started moving down. So that's one way that we can look for potential reversals. Now, there are some things to be careful about. Of course, the trend direction is going to be important, which we're going to get into in a second, as well as just understanding that, of course, the indicator by itself is not going to be a perfect indication of when the market will turn. So one way to kind of combat this would be to combine it with other factors. So let's go ahead and move into the next way of looking at the stochastic, which is going to be a pullback concept. Now, this is one of my personal favorite ways to look at the stochastic and to trade it. So if we have a market that is trending, the stochastic is going to be either very, very useful or very not useful. And I'll explain a little bit what I mean. If the market is moving to the upside, right? Take a look. You can see that we started to print overbought quite a bit. Right? So if you tried to just sell right here or sell right here or sell right here, those would have been tough entries, right? Because the market kept rallying higher. And so this brings me to a very, very, very important point when talking about any sort of oscillator, and especially the stochastic, is overbought is relative. Right? So it's not always going to be that when price prints overbought here, that the stochastic is right and that the market will reverse the downside. Because you have to take into consideration that this is measuring the strength or momentum of a market. And so here we have a very healthy and strong uptrending market. So in this case, it would probably be best not to try and short just because the market is printing overbought, because of the fact that we have a uptrend. So the direction of the trend is going to be important. So, well then, Nick, how can we use this? This is where pullbacks come into play here. We can spot possible continuation points on a trending market rather than a full-blown reversal. What do I mean by that? Well, we have a market that's moving to the upside. So if we're using the stochastic, maybe one of the best ways to use it is to combine it with the direction of this trend, meaning that we are looking for up movements or buys. So maybe we don't look to sell this market if the trend is up, right? This is just one way that you can look into trading with the stochastic indicator. So if the market starts to pull back, well, this is where the stochastic can be really handy. You can look for places like this, where we printed oversold. We printed oversold here, and we started to see a momentum shift back to the upside. Well, look at this. Momentum shift was showing right here, and the market hadn't started yet, hadn't started to continue that trend. So this could have been a beautiful buy opportunity in favor of this uptrend. Using the stochastic indicator, this could have gotten us in. We could have rode that next wave to the upside, basically looking at the shift of momentum that was in favor of that longer term uptrend. Again, you can see here's an example of maybe why we wouldn't want to try and short this market in a strong uptrend. You can see that would have been a very tough game trying to short this market as it's strong to the upside or to the bullish trend. Which brings me to my very next point, which is going to be using the stochastic as a filter. So I mentioned a little bit earlier that the best way to use indicators, in my opinion, is not to use them solely or to use them by themselves. The idea here with the stochastic is that it can be used, in my personal favorite way, as a filter or a bias towards a particular direction. So another way you can use it is you can use it with multiple time frames. So for example, if we're trading the 1 hour chart, but then we use the 4 hour chart reading using the stochastic, that could give us a bias or a directional bias on which way we would like to trade the market. So if the stochastic is printing that we were oversold on the 4 hour chart and we're looking for bullish opportunities on the 1 hour chart, we can use the stochastic in that sort of way. The next thing I'm going to mention is that using the stochastic can be very effective if we're combining it with other things, primarily other indicators and price action, right? So if you like price action, you can combine your stochastic knowledge that you've learned from this video with the price action concepts that you know. And if you don't know, you can check out under my playlist section. I have a free price action course for you to check out, and maybe combine some of the lessons that you learned from that with the stochastic lessons that we've talked about today. So kind of a recap, let's remember that the stochastic is essentially a measurement of momentum and the direction of the market. And it can also help spot potential shifts in that momentum, such as points like this, such as points like this, right? But remember, the other thing we wanted to point out is that using it in favor of a directional trend can sometimes yield better results. Guys, thank you so much for watching. I do hope that you'll subscribe to the channel down below and give this video a thumbs up if it was helpful to you, and we will see you next time. If you're looking to improve as a Forex trader, I've got an entire channel here full of free stuff to help you out. You can check out videos here, and if you're interested in my VIP service where you can follow along with my trades as well as join our membership chat room, you can check out the link down below in the description. Check it out. We'll see you there.